Hi, everybody. Scott Riley, the Market Update Desk, October 15th, or about 4 days post total knee replacement surgery. So we're having fun here, working from home, trying to stay focused on everything. We had a continuation of Fed speakers come out in the last yesterday and today. Wanted to review that, how the market's taking it, and where we're going. So yesterday we had Fed Governor Christopher Waller come out and signal that the future interest rate cuts he thinks will be less aggressive than the one we had in September, the half a point cut, as we move forward. He's indicating whatever happens in the near term, his baseline still calls for reducing or easing Fed policy, but to do it gradually, really more gradually than what the dot plot was actually showing us 6 weeks ago. And the reason for that is the key data points for the Fed have really been mixed, giving us two different views. Now, we also, in addition to Waller, had Fed President Neil Kashkari come out and suggest future interest rate cuts would be modest, and that's a new moniker or adverb that they're using, and reiterated that policy decisions would depend on economic data, going back to one of their favorite phrases, data dependent. So we got both these members coming out, I think, trying to tell the market that it's saying slow down, that we got our head over our skis, or at least the market, looking for 50 basis points in September, 50 in November, and 25 in December. Realistically, that's going to be pushed back, with the last jobs report being much more jobs than what were forecasted, and with wholesale and PPI coming out last week. I'm sorry, CPI and PPI coming out last week, showing that inflation is really, starting, the continuation of the cooling. They're trying to set proper expectations, I think, now. Now, keep in mind, that's just two of the members, but it's definitely been a parade of members talking over the last week and a half. Also in Europe, the next interest rate decision is going to come out later this week on Thursday. The ECB is on course to cut rates for a third time this year, as the policymakers suggest that inflation risks are cooling quicker than expected. So that's some good things over in Europe, where they've got a little bit of different things going on over there than we do. Geopolitically, we have oil, which has spiked over the last 3 weeks, which has pushed up some inflationary concern, and also one of the reasons why the 10-year bond has been creeping up. One of the things that happened late yesterday is Israel came out and said they are going to potentially moderate their response from what they had an attack from Iran about a week ago. Initially, it was thought they would attack the oil reserves and storage facilities in Iran. It looks like that's not going to be the case. And if that is true, we're going to get some stabilization of oil and gas prices. We're already starting to see that. We spiked about $76 in oil, and I think we're down to about 71.5 or 72 now. So cooling of that is going to filter through in the multiple levels of inflationary readings that we get. And the better the less expensive the oil price, the better we're going to see inflationary readings, which is going to lessen concerns for the Fed with continuing their easing policy. Mortgage-backed securities are trading pretty much sideways, hanging around support of about 100.18. We haven't seen big spikes either way over the last week and a half. 10-year bond still continues to be a tick above 4%, and that's an important barrier. So we're going to watch it really closely as we go forward. We also had the Empire State Manufacturing Survey come out this morning. That shows the health of manufacturing in the New York region. And that was reported at a minus 11.9 for the month of September. And that's a drop from a positive 11.5. And the expectations were 3.8. So it definitely came in on the cool side for that. We'll keep on top of everything here. When we do the videos, it's going to change a little bit depending on some PT I've got going, some knee pain I've got going on right now. We're here still to answer some questions if you've got them. 616-293-2189. The market is still this is a great time to buy. We're seeing a little softening for buyers, with homes being on the market a tick longer than what they were, and inventory ticking up, maybe about 6 or 8%. So we've always said this off season, the late fall winter time, is economically the best time to buy. Give us a call. We'll go into details why and help you out. 616-293-2189. Have a great day.